So let's do this. Let's look at this on Excel, shall we? We'll break it down and make it a bit easier. We're going to look at a couple pieces here. All right. So starting on the far left, minimum premium, $10,000 per year. PUA rider, $90,000 per year. Net out of pocket, 100 grand. 100 grand times 5 years is $500,000. What's highlighted in yellow? That's the first year you break even. All years prior to that yellow line, you have less in cash value than what your total payments are. That's the worst part about a whole life insurance policy. No matter how well it's designed, we typically have a negative hit up front, and really the name of the game is minimizing that negative hit as much as we legally can per the IRS limits and also the insurance company limits. When you do that, you minimize the upfront hit, you have an earlier break-even point, and you also see maximum cash value long-term, which is usually what people are interested in when you look at the cash value for the safety, liquidity, and tax benefits. So this is the illustration we just looked at. The dividend rate with this insurance company is 6.1%. If you've ever been exposed or presented with a whole life insurance policy and you were told the dividend rate with this policy is 6.1%, what does that make you think? Do you think your money is going to grow by 6.1%? I did when I first got into the industry because I see a percentage there. Most people think that. It's natural to think that. It's not how it works though. And how you can easily tell, look at the first year. You paid in 100 grand, you have $89,000 in cash value. That's a negative 11% return. Now we've got the insurance expenses in the first year, but what we can look at is as each year passes, does the cash value ever grow by 6.1%, which is what this illustration is based on, the 6.1% dividend. Well, we're going to use some fancy Excel formulas to see exactly what the percentage is. The answer is no. So annual ROR is just the net annual rate of return. First year, negative 10.6%. Next year, negative 1.79%. The reason why is because the first year was 89,000 and change. You paid in 100. Now it's worth 186. Think of it this way. If you had $89,000 sitting under your mattress and you add $100,000 to it, how much would you have under your mattress? Chelsea, you know? 189. Didn't mean to put you on the spot. So you have 189. What do you have here? 186 in this illustration. You have less. That's why we have a negative return. And then each year it gets better and better. But this displays the net percentage. And as we look at it over time, like look at this down here. Even at its peak, it's at 5.21%. It's not 6.1. I always like to clarify this point because it is confusing. I see a dividend rate, and a lot of times I think that's what I'm getting when I'm not. Now, if you're thinking, all right, this just made me even more confused, you can scratch all of this and look at this. Cash value growth. This just displays what you are getting net from the insurance company year over year. So important here, by the way, not to include your payments. It drives me nuts when I see people do this. I see something like this. Look at this. Year 5 or year 4, you had $400,000 in cash value. Year 5, you've got $516,000. That means it grew by $116,000. No, 100K of it is mine. So I'm going to back that out. Here's the net growth I received from the insurance company that year, $15,000 and change. So this column just isolates what I'm getting from the insurance company year over year net. So that isolates the annual growth. If I want to see the average returns, I would look at the internal rate of return. That's the average growth rate over the life of the policy. And the cash value gain is pretty simple. Look at this. It's negative until you hit that point where it's highlighted in yellow. And if we look at 65, you've got a $429,000 gain. And the reason why is because you paid in 500, you've got 929. The difference is the gain. Make sense? Pretty cool, right? So that's the breakdown of the policy. A lot of info there. Remember what we're going to hit on next? Using it. Let's see this. So he's going to use it now for real estate. All right. On the left, you've got the growth illustration. Here's what I want to hit on, actually. Let's do this. Okay. So this is what we just looked at on the left, 100K per year for 5 years, and then just let it sit and grow. On the right, we've got a loan coming out, $300,000. You can take loans anytime, but when he takes that $300,000 loan, what happens to his policy? On the right, cash value was 516. Now it's 223. What happened to the death benefit? It also came down. Now we're going to start to repay the loan at $50,000 per year. Light blue in this column right here represents your net out of pocket. So if this is you, you're paying a net of $50,000 per year. The column to the right of it shows how much is going toward interest. And to the right of that in purple shows how much is going toward the principal. So as you pay that back, what happens here? Well, look at the bottom. What's in blue? What do you see? The example where we never touched it was worth $789. In the example where we borrowed and then repaid, it's still worth $789. Remember what he wanted to do? He liked the life insurance policy because it could produce income down the road on a tax-free basis, but he still wanted to be able to use the money. He didn't want to just sock money away forever and then not be able to touch it. No, he likes real estate in his business. He wants to be able to use the money. What he also wanted to see is what his cash value is growing by and compare that year over year with what he's paying in loan interest. A lot of real estate investors love to see this because it shows the net numbers. What am I getting from the insurance company every year? And then what am I paying them in interest? That shows that on a year-to-year basis. And then we've got the totals on the far right, which just shows the total gain. So if we look at this, after that loan's paid, your total gain by year 14 is $298,000. And the total interest you paid to the insurance company is almost $70,000. So I came out ahead. That's what people are looking at. And if I'm in the red, I can see that up front. Like that is so, so important. When people have buyer's remorse with policy loans, it's when they don't see that and find out after the fact that they've got a negative return. It's like, no, don't play those kind of games. So that's using the policy. Now let's look at some income here. I'll go through this pretty quickly. This is the same policy. Here's the growth. You can see what it looks like if he never touches it. And then on the right, you've got income. He's going to start to take income at 60 years old. This policy, he paid in 500 grand total, generates $37,500 per year. So what we'll look at is annual income and also the total income. When you see that money coming out, cash value is going to be impacted over time, where it gradually comes down. The same is true of the death benefit. Watch what happens when I scroll down. We're assuming that he kicks the bucket here at about 90 years old. Total income received, 1.16 million. 500,000 of that was his principal. Everything above the 5 are the gains. And with the life insurance policy, because we didn't trigger a modified endowment contract, this is tax-free, those income disbursements. That's income coming from the life insurance policy. Remember the 37.5 number, because next We're going to look at the annuity. First, we've got the indexed annuity, which is a growth annuity. So with this guy, he's got an old 401k. He's going to transfer it to the indexed annuity. When I transfer money from a 401k to an annuity, it's treated the same as if it would be if I transferred it from a 401k to an IRA. No taxation on the transfer. There's the 300K. We've got the S&P 500 performance with a product that has an 8% cap rate. Account value, that's what the money is growing by. Then we've got the surrender charge. So what's very important to be aware of with annuities is if I cash out within the surrender term, which with this product, it's a 7-year term, I'll have the IRS penalties because it came from a 401k, 10% penalty tax. I'll have to pay income tax. I also have to pay the insurance company a surrender charge. This is an additional penalty on top of what I'm paying the IRS. So I want to see this up front and I want to understand it. Now, why people still do this is usually because they say, this is an old 401k. I'm not going to touch this until I'm 60 years old anyway, so I don't care. So that shows what we paid to the insurance company if we walked away within the first 7 years. After the 7th year, the account value and surrender value are equal. And the death benefit is the same as the account value. And I like to show that because a lot of times with annuities, people feel that if they die, the insurance company just keeps their money. There are some annuities like that where you can set them up that way. I would not recommend it, but if you set them up correctly, you'll always have the account balance that can be paid to your beneficiaries, which is nice. So that's a growth annuity. Let's look at the income annuity. And this is starting income at 60 years old. So he transfers 300K, doesn't look at the balance because he doesn't care about it. But at 60, it guarantees him about $45,000 per year forever. How much did he pay into the life insurance policy? Do you remember that? It's $500,000. How much income did the life insurance policy produce? At age 60, $37,500. With an annuity, he's paying in $300,000 and he's getting $45,000 in income. Which one produces more income? The annuity. Typically, an annuity is going to guarantee much more income than what we'll get with a life insurance policy. Trade-off the tax benefits, which we've got to analyze. But it is good to see that. We put in a lot less money with this. Keep that in mind. But there's the $45,000 per year. And then we do the same thing where we look at the total income. Let's package all this together and simplify things. So here's what we've got. To the left, we'll start off with the insurance products in purple. You've got the annuity income, $44,000 and change per year. Then you've got the life insurance policy income, and this is starting at age 60 here. Next, you've got Social Security, which he doesn't plan on taking until he's 62 years old. He'll get $50,000 per year. His wife will get 50% of that. Then you've got real estate income. He's got rental properties that give him about $4,000 per month. So here is his before tax income in retirement. This is gross. Then we've got his tax rate, which is easy to adjust, which is probably will adjust over time. But my point is, we do want to look at that and discuss it with his CPA because this piece, the annuity income, came from a 401k. So it's going to be taxed 100% of it. So that's where we like to look at the before and after tax income when we're looking at that retirement strategy with the pension income. All right, last one, and then we'll wrap up. We've got a couple in their early 60s here.